Welcome to the Old Fashioned Real Estate Show, where hosts Brian Leverage and Jeffrey Holst pour out old fashioned real estate advice.
Episode 6.
Hello, and welcome to the Old Fashioned Real Estate Show. My name is Jeffrey Holst.
I'm Brian Leverage.
And we're excited to have you here. So, Brian, tell me, how was your week?
Fantastic, Jeff.
Great. It's good to know.
I'm a man of many words today.
Yeah, it's typical. Anyway, so today we're going to talk about an interesting topic, something that we at the Old Fashioned Real Estate Show have kind of, I won't say we invented it because I've heard similar things before, but it's something that we're really, we really spend a lot of time thinking about, and that is what we call the Passivity Scale. The Passivity Scale is really just a scale that shows you, on one hand, things that are super passive, that are really easy investments that you're going to maybe make one decision and then forget about it. And on the other side of the scale, things that are extremely active, and that would be like, something that you have to basically make every single decision. You're maybe collecting the rents yourself.
Very hands-on.
Yeah, it's extremely hands-on. So the passivity scale is really the scale from one side to the other, with passive being most people's goal. But it's something that I think is often misunderstood. I actually got this idea when I was talking to Brian one day. You might not remember this or not, but Brian was talking to me about how he thought that people misunderstood what passivity was in real estate investing.
Yeah, to clarify a little bit of where Jeff's coming from on that point is, simply put, most people think a lot of seminars rely on this for coaching and selling you packages within real estate investing and mentoring programs. And the dream that's sold is real estate investing is a passive form of investment. And frankly, that's just really not true, with a couple of exceptions, which we'll get into a little bit of detail later on. But the short of it is this, you as the property owner, whether you're actively managing the property yourself or you're engaging with a property manager, you're still involved in the process. You still have to buy the property. You still have to qualify for financing. There's a lot of things that go into it, and that's before you've even bought it. And then once you've owned it, you're, again, dealing with the property management company. You're dealing with repairs of a certain nature if they're, more than, say, $1,000. And so forth. So it's not really passive. Yes, you can hire other people to do the lion's share of the work for you. But again, it's not what we call mailbox money, where you're literally just sitting back and waiting for a check to show up once a month.
Which I think that's what they like you said, it's what they sell you at the seminars and things. And certainly it is possible to make investments that are almost completely passive, but you sacrifice when you do that. And that's really what the passivity scale is addressing. And I kind of want to give you an example of what I mean in case it's not entirely clear. Even when you're talking about something that's not real estate investing, there's still a passivity scale that applies to your investment decisions. If you're investing in the stock market, for example, you could invest in a 401k where you, on the front end of that discussion, you might make 3 or 4 decisions and set a specific percentage to come out of your paycheck, and then you essentially forget about it. I mean, they even have target date funds now, right, where you can invest and say, I plan on retiring in the year 2045, and it will just make investment decisions for you based on what they think you would want if you're retiring in 2045, and then you can just kind of forget about it. That would be very passive investing. A little bit less passive on that scale might be something like picking stocks. You might say, I really like XYZ stock, so I'm going to go buy some XYZ, and then that stock is might have it for a year or two or 6 months or whatever it might be, and then you say, I'm going to sell that stock and I'm going to buy A, B, and C stock. And that's, a little bit more involved, but you're still not really involved in the day-to-day operations of the companies that you're investing in. You're just kind of making that decision. Something further down the scale would be, investing in a company that you personally, work for or that you own or operate, like being a CEO, for example, or, even having a significant minority percentage ownership in a company where you can actually call up the board of directors and say, I want some, I think you should do this, or I think you do that, and they would actually listen to you. So that's sort of how the scale works. And then I guess on the extreme end of that sort of stock market investing company kind of thing would be like starting your own company and taking it public. That would be very unpassive. I believe there's a lot of work involved in starting a company. Brian and I have both been through that in our careers, and I think we would agree that that's not a passive activity.
No, not at all.
So talkative today. I love it. I love it. All right, so, but we really want to talk about real estate. And when we're talking about real estate, the passivity scale works the same way as it does with stock market investing. And that is, there are some real estate investments that are more passive than others.
What would be an example of the least passive investment?
The least passive investment? That would be like if you were going out and buying, buying and rehabbing, I think, properties and making all the decisions on rehabbing it, and then renting it out and collecting the rent yourself and screening the tenants yourself. That's probably about the least passive investing.
Self-managing.
Yeah, self-managing. Absolutely.
And then at the opposite end of the spectrum, you have what are called REITs, which are short for real estate investment trusts. It's essentially like a stock, but what happens is other people run the company, they make the investment decisions, you're just parking your money with them, and you essentially get stock certificates, just like a publicly held company. Some are public, in fact, and you just get a dividend based off of your investment amount. But beyond that, you have no control over the day-to-day operations. So that's about as passive as it gets.
Yeah, I think
in terms of that.
That's right.
With maybe investing in a real estate syndication being somewhat similar. Those are smaller typically. They're not a real estate investment trust per se, but you have a different share or different class of stock than the managing principals.
Well, let me stop you there to maybe clarify that, because I don't think we've talked about real estate syndications before on the show. So in case you're not familiar with a syndication, what that really means is there's some group of people, typically called sponsors, that are pooling investor money to buy assets. And in most cases, syndications are project-based. So they're like, you might say, I want to invest, $50,000 to buy 2% of an apartment complex or 1% of an apartment complex, whatever it might be. And then there are other people that are active investors. They're called general partners typically in those, or sponsors. And those people will actually go out and find the apartment complex, and then they'll essentially sell you an interest in that complex, or from a technical perspective, in the company that owns the complex. And that's a syndication. And it's outside of the scope of this discussion on how those work exactly, but that's much less involved than, say, self-managing a property. Something that might be kind of in between would be like a turnkey investment. That's similar in passivity to, I think, to a syndication. You're going to do some upfront due diligence. You're going to evaluate the project and decide if it makes sense, but someone else is really going to be the one that, finds the property initially and proposes it to you, and then also manages it and then just pays you the distributions on it.
And it's worth noting that as part of this, typically the premium received for you as the investor tends to be not as high the more passive an investment gets, because you have more people in the chain of command, so to speak. Nobody really ever does that for free, of course. So you should expect to make a little bit less of an ROI on those types of investments, whereas if you're actively managing your own investments, your returns are going to be higher, but you should still account for your time in that overall equation and assign some type of a value to it.
Yeah, I think that's right. And I think we can maybe circle back to what we started the video on, which was property management. If you're looking at the passivity scale, Brian, where would you put professionally managed property?
It's going to be somewhere probably in the middle to maybe slightly more passive, depending on the types of assets that you're investing in.
Yeah, I think that makes sense. So that's really what the passivity scale is. And I think it's really useful when thinking about making investment decisions, because not everyone has the time or the energy to self-manage their properties. I've certainly done that for some of my properties, but on other properties, I've had professional managers handling it. And on other properties, I've even invested in a real estate investment trust. Sometimes it's nice to have some almost mailbox money. We won't call it mailbox money because you do have to, do a little due diligence on your own. You can't just trust what people tell you. But there are opportunities out there to invest as little as like $1,000 into a real estate investment trust. And most other investments in real estate are going to take a lot more money than that. So that's another, option for you to get involved in real estate investing. So
Yeah, well, I think we've covered a pretty good range of some of the different activities on that passivity scale today. Anything else to add?
No, I would just encourage everyone to get involved in real estate investing because it's been really great for myself and my family, and I think it's been pretty good for you too, and almost everyone we know. One thing I think that's really interesting is that that there are more millionaires made in real estate than in any other field in the United States. So I
That's
think
right.
it's a good opportunity to get involved. Thank you.
Have a great day.